Hi, my name is Brett, and I am the founder of Steady Option Income newsletter. I'd like to talk about how do you hold through risk events. And I'm going to approach this from basically the two main categories of subscribers that we have, which would be the larger accounts and then the smaller accounts, because the strategies differ a little bit, although there is some overlap. All right, so what do I mean by holding through risk events? These might be an earnings date that's coming up. It could be a high return stock. So the premiums are very high, they're very attractive, but it could be because there's other things going on with that stock that causes it to be more of a risk. Then there's sudden increases in margin. So all of these are, except for maybe earnings, unexpected events, risk events that can cause the stock to drop drastically. And really, depending on the quality of that stock, if it's a high risk stock, then there is a chance it could fall quite a bit. So if it's, for example, a therapeutics, pharmaceutical, biotechnology, maybe they have negative earnings, they're just not making any money, they're not as well known, these events here can cause a big swing in the stock. But sometimes you want to capture some of that high return without incurring the risk that we're talking about here. So how do you do that? So looking at it, say for a larger account, what would happen there? How do you decrease some of your exposure to these risk events? Well, what you would probably want to do there is just decrease in size. So you're still able to capture some return, but you don't have such a big portion of your portfolio exposed to this potential risk event. And when I say larger accounts, really looking at something up around, say, the $100,000 mark, where when you allocate a 2% or less than 5% to a position, you can do basically that number of contracts. You can do maybe 2 contracts or 5 contracts on some position and still be below 5% of your total portfolio. And just kind of going off of a contract requiring cash of $800 to $1,000 margin. So the larger accounts can still hold that position, still try to take advantage of the return, but if it doesn't work out, it's not such a big part of their portfolio that's getting the exposure. Now, when we move down to the smaller accounts, the strategy is going to change there, because if you only have, let's say, $10,000 to $20,000, maybe even $5,000 in your account, writing one put contract is going to take up a significant portion of the account. So just one contract can range from 5% to 10% of the account. Now, if you got a $10,000 account, the contract margin is $1,000 in cash. You're already at 10%. Quite a large exposure for just one contract. So it's very difficult to get away from the risk event when you've got 20% of your portfolio exposed on the smallest position that you can take. So what happens there? Well, if you're at something above one contract, you would want to decrease, or the safest bet is just to avoid that risk event altogether. So earnings, surprises in margin increase, or just going in with a risky stock, that's areas that you can just stay away from. So then you might ask, well, what does this leave me in regards to return? Well, in that case, more than likely you'd want to stick with better, well-known brands or companies that are not in the area of, say, pharmaceuticals, therapeutics, biotechnology, those areas there that tend to have large swings and can miss being approved by the FDA, for example. Just all of a sudden news comes out and that stock is chopped in half. So then you're going to lose on your position regardless, because you're already significantly below your strike. So the best bet for these smaller accounts is just to stay away from the risk events, stay with the better known companies and the lower returns, but produce a consistent profit, because these events here can wipe out your account or leave you basically insolvent. So what about leading up to the risk event? So you are holding your position, and this would be for small and larger accounts. You're holding some position in a stock that's maybe not as well known, that has been kind of volatile in the past, and you know this is a risky stock because you got a high premium on it, significantly high premium. Maybe it's got a higher margin requirement. So there are some things going on under the covers with this stock, with this company, that puts it on the riskier end of things. So leading up to the risk event, what you'd want to do is just decrease in size. Or if there's some profit on the table, why not take it? And then just get out of the position and out of the way of the potential risk event altogether. So these strategies, again, will work with a small account, they'll work with a large account. So you got a stock that's got a high return on its options. So the option premium is a lot higher than what some of the blue chips would be, say a Microsoft, an Oracle, GE, Apple. The returns on this other stock are much higher because there's a lot more risk to it. So it's just, again, what we've been talking about. Go in light, go in with a smaller size, grab some return off of that, and then try to avoid the risk events that may be coming up, such as an earnings date, potential news release. Just get out of the way of those things. So you can still take advantage of higher return, higher premiums, but you just have to do it in a smaller size. This will avoid having drastic negative impact on a portfolio. And enough of those kinds of events will leave the portfolio undercapitalized, and then you're not able to take any positions at all. So the smaller returns on the better known companies are going to be just the steady profit drivers each month. And periodically you may find an option with the higher premiums that you just go in light, try to stay out of the way of any upcoming events that you know of, specifically earnings. And then when the event is coming up, just close that position out, take what profit you have, and just rely on your other well-known companies with the smaller returns. So this way you get a little bit of alpha off of the top on these riskier options without having or potentially having a lot of damage done to the portfolio. So again, my name is Brett. I'm the founder of Steady Option Income daily newsletter. So if you're looking for a list of highly vetted options delivered to your inbox each day the market is open, please come visit us at steadyoptionincome.com. Thank you.